Why everyone agreed right before it failed. Consensus feels comforting. When everyone reaches the same conclusion, doubt seems unnecessary. And for a long time, that shared certainty appeared to work perfectly. To understand why this story matters today, we need to look at how agreement forms inside markets. Not loud agreement, but quiet alignment, the kind that emerges when incentives point in the same direction, when data peers confirm itself, and when opposing views slowly disappear. This is not herd behavior driven by emotion. It is convergence driven by logic. The environment that allowed this to happen felt rational. Information was abundant. Models were sophisticated. Historical data stretched back decades. Analysts weren't guessing. They were optimizing. Each decision was supported by research, backtests, and peer validation. Agreement didn't feel forced. It felt earned. As strategies converged, the market rewarded them. Performance stabilized. Risk metrics improved. Outliers underperformed and were quietly sidelined. Over time, dissent became inefficient, not because it was wrong, but because it was costly. Holding a different view meant explaining volatility. Agreement meant smooth results. This is how consensus deepens, not through persuasion, but through reinforcement. Each success narrows a range of acceptable ideas. Each calm period strengthens a belief that the shared framework is correct. Eventually, disagreement stops looking insightful and starts looking reckless. What made this moment fragile wasn't ignorance. It was unanimity. When too many independent actors reach the same conclusion for the same reasons, diversity disappears. And without diversity, systems lose their ability to adapt. At first, the benefits were undeniable. Trades were efficient. Capital flowed freely. Confidence felt justified. The market appeared to have solved a problem that once caused instability. But beneath that harmony was an untested assumption. That agreement itself reduced risk. That if everyone saw the same thing, it must be true. And that assumption was about to be tested. As consensus hardened, it began to shape behavior in subtle ways. Decision-making accelerated. Fewer scenarios were debated. Risk committees spent less time questioning assumptions and more time refining execution. When outcomes align consistently, process starts to feel secondary. The market itself began to mirror this alignment. Price movements grew smoother. Volatility compressed. Signals that once conflicted now pointed in the same direction. Correlations increased quietly, almost politely. Nothing looked dangerous. In fact, everything looked efficient. This efficiency reinforced belief. When prices behave as expected, disagreement feels unnecessary. When strategies work across institutions, caution appears redundant. Each participant assumed that if something were wrong, someone else would have noticed. Collective intelligence became a substitute for independent skepticism. In this environment, warning signs didn't disappear. They were reframed. Minor anomalies were explained away as temporary noise. Outliers were attributed to technical factors. Data that didn't fit the narrative was adjusted, filtered, or deferred, not out of dishonesty, but out of confidence. The cost of questioning grew. Raising doubts meant slowing decisions. It meant defending underperformance. It meant standing apart, while others benefited from alignment. Over time, the system learned to reward agreement and penalize friction. What made this phase especially dangerous was how calm it felt. There was no euphoria, no mania, just steady progress supported by shared reasoning. The absence of drama became evidence that the framework was sound. But consensus does not eliminate uncertainty. It concentrates it. When everyone relies on the same assumptions, those assumptions stop being tested. They become invisible. And invisible risks do not fade. They accumulate. By the time the first cracks appeared, the system was no longer prepared to interpret them. Because when everyone agrees, there is no reference point for doubt. And that is when agreement stops being a strength and starts becoming a vulnerability. The conflict surfaced not as contradiction, but as confusion. Outcomes began to drift from expectations, just slightly at first. A model missed a move. A hedge underperformed. A correlation behaved differently than it always had. None of it looked alarming on its own. What made it unsettling was how difficult it became to explain. The usual narratives didn't fit. Adjustments that once restored balance now produced weaker results. The system responded by doubling down on refinement instead of reconsideration. Parameters were tweaked. Time frames were shortened. Confidence remained intact. As pressure built, the absence of dissent became a problem. When everyone shares the same framework, there is no opposing lens to challenge it. Questions sound like disruptions. Alternative interpretations feel unnecessary. The market loses its ability to debate itself. Positions remain large because there was no clear reason to reduce them. Risk controls remain relaxed because historical behavior still supported them. But history was no longer a guide. The environment had shifted quietly while assumptions stood still. When prices moved unexpectedly, reactions were delayed. Participants waited for a confirmation that never came. They assumed the deviation would correct because it always had. But this time, there was no counterforce. No group positioned differently enough to stabilize the move. This is when agreement began to work against the system. Instead of absorbing shocks, it amplified them. Each participant responded the same way, at the same time, for the same reasons. What should have been offsetting behavior became synchronized action. Losses did not explode. They accumulated, slowly at first, then persistently. Confidence eroded not through panic, but through realization. The framework everyone trusted was no longer aligned with reality. By the time the conflict was undeniable, the market faced a difficult truth. Consensus had removed its ability to adapt. And adaptation was exactly what the moment required. The failure did not arrive with a dramatic break. It arrived with slow realization that the shared logic no longer worked. The same assumptions, once reinforced by alignment, now produce the same losses across portfolios. Agreement stopped feeling efficient and started feeling dangerous. What finally unraveled the system was not a single mistake, but the absence of alternatives. When outcomes diverged from expectations, there was no opposing force to stabilize them. No group positioned differently enough to absorb pressure. The market had optimized itself into fragility. In hindsight, the warning was clear. Consensus did not form because uncertainty disappeared. It formed because uncertainty was temporarily hidden. Calm conditions rewarded alignment. Success narrowed thinking. Over time, agreement replaced resilience. Afterward, reviews focus on models and incentives. New frameworks promised better balance. Diversity of opinion was praised again, but the deeper lesson was structural. Markets need disagreement to function. They need friction. They need participants willing to be wrong differently. This pattern continues to matter because it repeats quietly. Whenever alignment feels earned, whenever disagreement feels inefficient, whenever success looks stable enough to trust, the same risk begins to build, not from ignorance, but from confidence. Consensus is powerful. It reduces noise. It accelerates decisions. But without challenge, it also removes adaptability. And adaptability is what markets rely on when conditions change. Why